Welcome back, America. I'm Hugh Hewitt, joined by David Bahnsen from the West Coast. David is the founder and managing partner of the Bahnsen Group. You can read all about what David thinks daily at dividendcafe.com. David does not like tariffs and taxes, and he has to explain to me why all these tariffs are in place and the market's going to new highs. Why is that, David?
The biggest thing that brought markets to new high is the president backing off of doing all the tariffs he threatened to do. So tariffs become a much bigger problem when they actually happen than when they get talked about. But there are some new tariffs that have gone on. It's a tiny fraction of what was discussed on April 2nd, Liberation Day. But nevertheless, there is a cost to the economy, and a lot of these are brand new. There's multiple objectives from a policy standpoint that the administration has with the tariffs, and some of those are not going to come together. Some of them will, and I want to call balls and strikes as we go. But again, Hugh, when the market dropped 5,000 points in 4 days in the immediate aftermath, and then all of those threats were repealed, and then in the 145% threat on China, and that was taken away, and a full, complete exemption for semiconductors and this little thing called smartphones that a couple Americans have. The waivers and exceptions change the game quite a bit, but there are higher tariff costs, but they're just not at the gravity that many of us were concerned about.
Now, I want to zero in on the Japanese deal, because Japan was closed to American cars, and now they have to let them in with a 15% tariff, which is the reciprocal tariff. Do you like that portion of that deal?
Well, here's the thing. There's a give and take to it, and I'm rooting for it to do well. I will tell you, Hugh, I would not be bragging if I were the administration that all of a sudden Japanese are going to buy Ford F-150s. Remember, their tariff on our auto imports for 50 years has been 0%. Their issue was that they were requiring emission standard checks on their end that was basically a deal breaker, and that part seems to have gotten negotiated in much better terms for U.S. But I will be very surprised if their consumer demand ends up being there for American imports. But I hope I'm wrong. But again, they had threatened 25% universal auto tariffs, and they lowered it to 15%. So that ended up being something where the market expected a worse response. And even though 15 is higher than 0, it's lower than 25. A lot of U.S. auto companies are a little concerned about the deal, but you saw how much the Japanese car maker stocks went up yesterday.
Yeah, well, I think what the president has done with Scott Bessent and the trade rep is to socialize the idea of a universal 10% tariff, which is basically distributing the cost of American defending free trade in the world, open logistics. And I think there's another thing going on, at least I believe John Ellis. Do you read news items by chance, David Bahnsen, every day?
Yes, I do.
So John Ellis had a piece on Friday, another piece on Saturday, telling me and stunning me that the private sector investment in AI in the United States over 2 years will be $2 trillion, a private sector stimulus. I'm astonished. Were you astonished? Well, that's your business. Was he right?
No, I think that number is about right. I don't know. I don't think that is astonishing at this point, because that's been kind of the pro forma expectation. It's a private sector investment, but remember that cuts both ways. It's a private sector expense for the companies buying it, and it's a private sector revenue for the companies receiving it. And in the private sector, you expect that interchange of expense and revenue to create something. It's a very large amount of money where the ROI for the expenditure side is unknown. What the hyperscalers will end up getting out of it, there's risk in this, and I love that risk being isolated to the private sector. Right now, we're in the revenue side of it for the infrastructure companies making the chips. So that's why NVIDIA has been the beneficiary, but there isn't yet, like with the internet, clarity as to who are going to be the big users that end up benefiting. And that's where there's still a lot of upside opportunity for the American economy. But it's there's a lot of unknowns there, but I'm excited for where it will go.
Well, here's my big question, the biggest market uncertainty for me. And I'm kind of a very cautious investor, David. It's that We don't have the energy to support AI. We don't have nukes. We don't have small modular reactors. The cost of electricity is going up dramatically. It's another thing Ellis covers, as does the Journal and many other things. What do you think is the hidden energy trap out there? Is there one? Am I over-worrying this problem?
Well, no, you're not over-worrying it, but I believe that we have to remember the history of how these things have generally gone is that market-based solutions come and surprise people. But that doesn't mean that they're wrong to worry, that there are situations that there's a deficit in how we're going to address it. There's a gap. The data center build out, the providing the power, and the utility support behind it. There's a lot in the sort of supply chain of services to get to that point. I just have learned over the years that market-based solutions out of a profit motive can do amazing things. And when the government gets out of the way, they can do even more amazing things. I'd be looking to the oft demonized private equity sector, private credit sector as an amazing solutions provider. Hugh, where did fracking come from? Was it purely just a Permian Basin oil and gas story, or did there have to be capital markets to bring it when public markets had basically walked away, especially in the ESG moment? Private equity, private credit. There is going to be a phenomenal interchange between U.S. capital markets and U.S. energy need.
So last question, David. I had breakfast this morning with Jonathan Bush. He's probably going to run for governor in Maine. And I said to him, Maine has a gazillion people who live here 4 months a year and then they leave, because they have an estate tax and they have an 8% income tax. It's a crazy place to move to. However, if you lower it to 4% and you get rid of the estate tax, a lot of these people will stay. Now, American Legislative Exchange Council is one of my clients, one of my sponsors, and they're out there preaching the gospel. Do you think all the states are going to race to lower their tax rates to be competitive with Tennessee, Florida, Texas, Missouri? Ohio's gone to a flat tax. Does that have to happen if you want to get business?
No, not all of them will, but all of them should, and a lot of them will. But there are a lot of states that will live off of the bank capital they have. Look, you and I both know as California refugees that California doesn't deserve the tax base it has, the population center. And we talk about how it's starting to have negative migration and bleeding some people out. But relative to the perversion of what they do in their tax code, it should be much worse. But there are people who love the weather. And, you know, I'm sitting here in New York City right now where they've done a lot to try to chase people away. It's still the most vibrant economic city in the world. So there's certain places that will live off, that will take it for granted. But you're right. There will
you
be
give
states
Comrade
that become
Mamdani,
the future Tennessees.
You give Comrade Mamdani 6 months, David, you might be down in Virginia or Tennessee with me. That's what I think. David Bahnsen, dividendcafe.com. Thank you for joining me, my friend. You always bring illumination.